Hello, and thank you so much, Karen. Appreciate everybody joining us today for our year-end webinar. I know this is a particularly important time of year for everyone who's in the accounting teams and the billing teams. It can be very stressful thinking about getting everything ready for tax time, and it's really one of those things where if you don't plan properly, you can be overwhelmed come the first of the year, because you've got all your regular duties to do in January, all the payroll and the billing and all those things that you have to do on a day-to-day basis anyway. But then on top of it, you've got all these extras that you have to do to get ready for tax time. So I always tell people that it really saves you a lot of stress and a lot of extra work if you can sort of, even it out over the next few months. Do a little bit in October, a little bit in November, a little bit in December to stay on track, so that when January rolls around, you're not, freaking out and spending 80 hours a week trying to get ready for everything. So the other thing that's really important is if you wait until January, sometimes it's too late to deal with some tax planning items. Your CPA really needs to sort of help you make sure that everything that you can do to minimize taxes is done in the fourth quarter. If you wait until January 1, it's too late to go back and do some of those items. So we'll talk about that more in detail. So one of the first things that I always tell people is maintain, right? You need to be doing things all year long, not piling things up and waiting till year end. I'm a big proponent of monthly checklists. Anyone who works with me on a regular basis probably knows this about me. I have a month end and a year end checklist that I tend to give most of our clients that I work with. And it really helps you kind of stay on track and make sure that all the things you're supposed to be looking at monthly are being looked at. It's so much easier to find and correct problems within a 30-day range than it is if you wait until year end and now suddenly you've got to go back and find where a problem was over a whole year. That really can make things a lot more complicated. And also, if you find something is being done incorrectly, like maybe you have an employee, maybe it's a newer employee, or maybe just someone who's been helping you out, or whatever it might be, maybe they are doing something incorrectly and you didn't even realize it. Maybe they just were never trained on how to do it properly, or maybe they forgot. If you catch something in a 30-day period and you go to that person and you say, hey, look, the way you're doing something is causing a problem, let's get you back on track and do it correctly. How much easier is that to nip that in the bud than to wait and find out at the end of a whole year that you've got someone who's been doing something wrong all year long. So really, staying on top of that and making sure that things are being handled on a month-to-month basis is a whole lot easier. Also, if you've got somebody who's error-prone on your team, find that out sooner rather than later, right? Because if they need to be put on, some sort of, watch, probation, whatever it might be, you really want to know if you've got someone who's a problem on your team. So just be mindful of that. And then keep your data entry up to date. So when I say data entry, I'm talking about making sure all your payments are posted, your bills have been finalized, depending on what product you're using, could be updated or posted. Is different terminology in different software products. Make sure your trust transactions are being properly entered in a timely fashion. All your accounts payable is entered. I go in at the end of the year sometimes and I see these stacks of accounts payable that have never been entered in the system, and I'm like, whoa, what is all that? If you don't know what's outstanding to be paid before year end, that makes life really challenging as well. Make sure your payroll is being posted timely and all the liabilities are being paid, your benefits and your tax liabilities. And then, of course, as is common sense, make sure that your bank reconciliations are being kept up to date on all accounts, trust and operating. And make sure that the stale checks are being monitored. It's great to reconcile what was cleared, but we need to pay just as much attention to what hasn't cleared and if there's any issues there. And if you have all of this data entry, up to date, then there should be no issue with giving your CPA a set of your third quarter books, right? Your financials for third quarter, so that they can take a look, he or she can take a look at how you're doing year to date. That's going to give them a really good look at what you might be doing in need for tax planning. Because if the firm has made a boatload of money this year, And you need to do some tax planning to try and minimize the tax liability to the partners, the shareholders, or depending on what kind of a corporate entity you are. If you're a corporation or a LLC, partnership, S corp, all different types of entities, taxes are going to flow through differently. But the bottom line is most CPAs are going to try their hardest to minimize your taxes, but they can only do that if they're getting accurate figures as of third quarter, and they can kind of see and project where you're going to be at year end. So that's really, really critical. You don't want to give them books where you're missing a whole lot of postings. That doesn't give them the accurate financial picture. So try to do that and get with your CPA and plan accordingly. Also, this is particularly relevant if you know that you're going to need to have some major expenditures before year end, like do you need to maybe upgrade some equipment, or are you worrying about maybe Christmas bonuses, or who knows what it might be. If there's some sort of a major expenditure that you need to be planning for, having that big picture of your financials and where they stand today at the end of third quarter is really important. Okay, one of the other things that I see a lot, and you may not even realize is the problem, is you cannot use your trust accounts, your IOLTA accounts, as tax planning mechanisms. I see a lot of firms that they go, oh, well, we've made too much money in 2017, so we've got all this money sitting in trust that could be dispersed. We'll leave it in there till the first of the year, and that way it's not taxable income to us till after the first of the year. They try and defer income to the new year by leaving money in trust that has actually been earned. That's a big no-no when it comes to the IRS. So now you may never get audited, which is great if you don't, but do you really want to run that risk? The IRS has clearly stated in their attorney audit technique guide that this is an audit issue, and if you are unfortunate enough to be pinned for an audit, you are selected for an audit, then you will absolutely have a problem if this is the way you've been handling your trust accounts. So be very mindful of that. You really do need to be conscientious about looking at what's in trust at the end of the year and moving to operating what has truly been earned. Okay? All right, so one of the other things we always recommend is, let your timekeepers know how they're doing. If you have goals in your firm, if you have timekeepers who are supposed to be hitting certain billable hourly goals or revenue goals or whatever it might be, let them know how they're doing. If they don't personally have access to the reports in your database or some sort of a dashboard view of their metrics, then it would be really helpful. You don't want to sort of spring it on them at their annual review and say, well, you really didn't hit all your goals last year. Well, how would they know that? They can't fix something that they don't know is broken. So I always tell people that, and this is to me not just something you should be doing at the end of third quarter, it's really something that should be a monthly or a quarterly at the minimum event, that you give them some sort of feedback on how they're doing, and you really do stay on top of their reports and their metrics to understand what may need to be modified in their behavior to be considered a valuable team member. Okay, so there's some absolute must-dos that you have to do at year end, and then there's some things that we recommend. So at a bare minimum, what must you do? Well, you really obviously have to get on all of your data entry for 2017 and do all your bank recs, which we talked about a moment ago. You have to get your 1099s out, and we're going to talk more about what it means to do accurate 1099 reporting as well. We'll do that in a few moments. You must get your W-2s out. So those have to be out by January 31st. So make sure all your payroll, that you've reviewed all the payroll reports, make sure that no corrections need to be made or modifications need to be made on W-2s, and make sure that those get out accurately. And then, of course, get your financials to your CPA for tax preparation, unless, of course, you're having an extension. If you know you're going to be filing for an extension, corporate taxes are due by March 15th, and then, of course, personal taxes by April 15th. So if you know that there's no way in God's green earth you're going to have everything done and your CPA is going to have taxes ready to go by March 15th, then you're going to want to ask them to file an extension on your behalf. Okay? All right, the things that you should do that maybe aren't as mandatory, I guess is the word I would use, is the following items. So budget. It's really important to plan and budget for the following year. You know, you can certainly do a look back on the last year or two and say, well, you know, where were we at actual to budget? If you've never done a budget before, then maybe use your actual figures as a starting point to do your budget for the next year. Now, most software products, most legal time billing and accounting products will have a budgeting tool for you. That allows you to either copy a budget from a prior year or use your actual figures from a prior year to kind of start a new budget for the new year. And then you can adjust. Once you have all the baseline figures, you can adjust up or down based on what you know you're going to need. So, you know, for instance, if this year in 2017 you didn't need any new equipment, but next year you know there's going to be a whole bunch of your computers and laptops that need to be replaced, then obviously you're going to want to budget accordingly for new equipment, right? So that's a great example. You want to be able to plan accordingly and not exceed, you know, your expenses and without also exceeding your income. So make some plans as to what you want to do as far as revenue and expenses. Make sure that you are taking a look at your aged accounts receivable and your aged work in process. I go into firms all the time where I see just huge amounts of aged WIP and AR. And when we actually look at those reports in detail, they go, oh, well, that should be written off. Or, oh, that never should have, you know, that WIP needs to be written off or written down or whatever. And I'm like, okay, but it's been sitting out here forever and it's never been written off or written down. And you know, what's the deal with it? Because it's skewing your reports. If you look at your reports and you say, oh, it shows we have $1 million in AR, and in reality, you really only have 600,000, that's a big difference. So you need to be looking at those on a regular basis, or forcing your attorneys to be looking at those reports on a regular basis. And then, what do you want to do with this? Are we going to collect this? Or, you know, if it's WIP, you need to decide, are we billing it or are we writing it off? If it's AR, are we collecting it or are we writing it off? Like, let's make some decisions and not let this linger out there for all eternity and skew our reports, because it's so, you really want to have accurate reports. You can't see how the firm is doing if your reports aren't accurate. So be mindful of that, and year end is a perfect opportunity, third quarter and fourth quarter, perfect opportunity to kind of get through all those aged AR and WIP balances and do something about them. Circulate those reports to the partners, do whatever you need to do. Address stale items on bank reconciliation. I regularly, again, work with firms and I look at their bank recs and I see stale stuff on there that from years prior. That's a problem. You know, if you've got a check that's been outstanding for 3 years, no one can cash that check. So what are we doing with it? Are we voiding it and reissuing it? Was it never received by the person, or was it just not necessary? Was it, the case settled and, oh, we never used that check and it's actually stuck in a file somewhere? What's the deal? Why is that item still outstanding? Deposits. I go in and I sometimes see stale deposits. I'm like, okay, a deposit should never be in transit longer than max a couple of days. So if you've got a deposit that's outstanding from like a year ago, there's a problem. There's no reason a deposit should be outstanding for more than a few days. So those are things that absolutely are red flags. And again, it's skewing your bank balance. So if you think that the bank balance on your reports is accurate, but you've got all these stale items, your bank balance is not actually accurate. So, be mindful of that and make sure you're taking care of that. A lot of people just tend to, oh yeah, I reconcile my bank account. Well, they're reconciling what actually cleared, but they're not paying attention to what's outstanding. So both are equally important to get an accurate bank balance. Address old trust balances. So in most states, there is this function where if you have money that belongs to somebody else and it isn't claimed within X number of years, like in Virginia, for instance, where I am, it's 7 years, you have to submit that to the unclaimed property division of the state. So my advice to you, don't let it get to 7 years. Don't let it get that old. You need to, most trust accounting software has a report of some sort that you can run that shows the last activity on that trust account, the date of the last activity. So if there's been no activity for a year, 2 years, 3 years. You need to be monitoring that, and you need to take a look and say, well, why do we still have this money that we're holding for this client that hasn't been touched in years? And question that. Talk to the attorney who's responsible for that file. Find out, should we return this money to the client? Should we, what are we doing with this? And make sure you don't let it get to the 7-year mark, because then guess what? It becomes really hard to find people. People move, people, change addresses all the time. And if you don't have a forwarding address, and you don't know how to get in touch with that client, if it's their money, then you're going to have to go through the rigmarole of having to submit it to the Unclaimed Property Division of the state. And let me tell you what, that is not fun. There are all kinds of forms, and you gotta, it's a nightmare. Trust me, very time consuming. You don't want to let it get to that. So do yourself a favor and keep on top of that, okay? And then just a general comment to constantly, look at how you're doing things, review your data, look for ways you can improve, and again, have monthly checklists that will keep you kind of on top of these things that might be problem areas in your firm. All right, so as we mentioned, just reinforcing the whole bank reconciliation concept, really being mindful of what is stale. I regularly work with folks who just have this backlog of stale stuff that they just never paid attention to. They only paid attention to what was clearing, and it's a huge problem, because now, here you are now years later, and you're trying to, figure out what happened with these items, and it's really a struggle to figure out what the situation was. And it's really a problem when the check that was issued was for a client cost advance. Because think about it, if you issued a check, let's say, I don't know, a filing fee or a court reporter fee or whatever it was, on behalf of a client, and you billed the client and they paid for that cost. Well, now you find out 2 years later, because you weren't paying attention to your stale items, oh, we settled that case before that filing fee ever was needed, so the paralegal or somebody in the matter just shoved that check in the file. They never gave it back to the accounting department. Well, it never was mailed, so of course it never got cashed. That's why it's stale. That's why it's uncleared on your bank rec. The folks in your firm really need to be educated that they need to give you back any checks that they issue for you that you do not use, right? So if if they ask for client costs and then they never mail it, they need to give it back to you so that you know to void it. Because otherwise, if your client pays for that cost, and now here it is 2 years later, you figured out the client's paid you, but you never put that money out. Now you got to void that check. Now you got to refund that client that money because they paid you for it and you never really incurred it. So there's all kinds of extra steps that, and hoops that you have to jump through because of that. And so it makes more work for you in the long run if you don't keep up with those stale items. I mean, rule of thumb, if a check really, if it's more than 6 months old, what's going on with it? I would even question if it's more than 3 months old, like, why hasn't somebody cashed it yet? It's really keep on top of that. Contact vendors who haven't cashed the check and say, what, we have this check outstanding for you. You haven't cashed it. What's the deal? Maybe they didn't get it, or maybe, figure out what happened with it, because it really is going to save you a lot of time and energy in the long run if you can do that. A bank should not be cashing a check that's presented more than a year old. Most checks will actually, well, not everybody's, but a lot of people will put on their checks void if not cashed within X number of days or months. So, I don't know if your checks, you might want to check to see if your physical checks actually have some sort of a statement about how old they have to be before they are no longer valid at the bank. It's not a bad idea to have something on there that says void after X number of days, weeks, months, years, whatever, because that can sort of be your guideline then as to when you need to void stale stuff. Okay. So review your financial statements at year end. Check for miscoding. I can't tell you how many times when I look through somebody's financial statements, I look and I see that they posted a fixed asset as an expense or vice versa. And if you're not sure what should be posted to a fixed asset account versus your expense account, then it's a great question for your CPA. They will usually be great about giving you some guidelines on that. Usually, if it's something you're going to hang on to, if it's a piece of equipment or furniture or something of that nature that you're going to hang on to for more than 2 to 3 years, it's supposed to be a fixed asset. Some CPAs will say, oh, if it's more than $500, make it an asset. If it's less than $500, make it an expense. Some CPAs will do it by amount. Some people will do it by the length of time that you're likely going to keep it. I think if you ask the IRS, they'll probably tell you it's the length of time you're going to keep it. For instance, an iPhone may cost $800, but you turn it in every 2 years, let's say. Well, that could arguably be expensed because it's going to be held on to for less than 2 to 3 years, but yet it costs more than $500. So talk to your CPA, get the rule of thumb that they want you to use, and make sure that your coding is being handled correctly. Okay. Make sure that your payroll and benefit liability accounts are looking right, because particularly if you're using an outsourced payroll service, they typically will handle all your payroll taxes, so there should be a zero balance in any liability account for that. Benefits, you may at year end have like your retirement plan matches perhaps that you haven't paid yet. As of 12/31, you may not pay those until later the first quarter. So certainly there could be a balance hanging out there. But if there are other balances on 12/31, usually most people will pay off all their benefit accounts on 12/31, with the exception of a retirement plan match. So be thinking about that, be looking at that. Does anything look inflated in those liability accounts that maybe you need to check on? Make sure that suspense accounts and miscellaneous, like miscellaneous expense or miscellaneous office expense, that type of thing, they're not highly inflated, because again, those are accounts that the IRS is going to look at if you get audited. If they see thousands and thousands of dollars in these miscellaneous or suspense accounts, they're going to be like, red flag, what's that about? Because people tend to just throw stuff into those accounts when they're not sure where to put them. And a lot of the time it's incorrect coding. So it's something to be mindful of. Make any adjusting journal entries that you need to make to address those things. Okay. All right, so let's talk a little bit more about 1099s. 1099s are required, and by the way, the IRS is cracking down on this a little bit more lately. They basically, anyone who is not a corporation, like an INC, anyone who's not a corporation should be getting a W-9. That includes LLCs, well, the thing about LLCs is you can file as a partnership or as an S-Corp. So if they're filing as an S-Corp, you don't need to 1099 them. But if they're filing as a partnership, you do. So the only way you're going to know that is to give them a W-9. So I always say it's better to put the onus back on your vendor. Send them a W-9 form. You can get the forms free from the IRS website. Okay, you can just download the PDF and send it on over to your vendors. It's much better to put the onus back on your vendors and say, hey, you need to tell us if you're 1099 eligible or not. And then when they respond to you, you can say, okay, great, we know that they are or they aren't, and then you can flag them accordingly in your accounts payable system and make sure that you're issuing 1099s appropriately. Okay, it is one of those things that the IRS is coming back with some pretty significant penalties. So it's very important that you be mindful of this. I actually had a client tell me one time, well, we don't issue 1099s because none of our vendors ask for them. I'm like, did you, what? Because of course no vendor is going to ask for them. Everybody would love to get paid without declaring taxes on that. No one asks for 1099s, folks. But it's the law. It's your responsibility to give them one. And if when in doubt, if you're not sure and you haven't got a W-9 back from them, then I would just issue one. Unless that they're like an INC, like an incorporated entity with, then I would absolutely say when in doubt, issue a 1099, because you don't want the penalty coming back on you if you get caught for it. And it's such a pain if you wait until January and then you go, oh my gosh, I don't know if all these people are 1099 eligible or not. Start getting all your W-9s out to your vendors now if you haven't already gotten them. I'm a big proponent of when you add a new vendor to your system, send the W-9 out to them right away, because then you can kind of keep up with it. But if you absolutely haven't done that and you now know you're going to have to send a bunch out before the end of the year, get it done now. Don't wait until January and you got a January 31st deadline coming at you and suddenly you're scampering to meet it to get your 1099s issued. So I would highly recommend getting on that now. because it's time consuming. You'd be amazed. Depending on how many vendors you have, it's incredibly time consuming. Okay, so we've talked a little bit about the aged AR and WIP. As I mentioned, make sure that I say anything over 90 days is really, get it addressed. Do you need to apply retainers to that AR or WIP? Get it billed, whatever it takes. Make sure that you're not leaving a whole bunch of old stuff that needs to be addressed out on the table. I would particularly say this is critical when it comes to client cost advance. The IRS Attorney Audit Technique Guide, Chapter 3, if you want to go look it up, and there's a hyperlink in these materials that we'll get to you. There's a specific section that says you must put your AR and WIP accrual balances for client advances on your balance sheet. So most firms are what we call cash basis accounting, but in this, the IRS says your cash basis for fees and soft costs, but when it comes to client cost advance, you're basically on accrual. So most CPAs refer to that as modified cash accounting. So you are supposed to show those outstanding advances for AR and WIP as an asset on your balance sheet. And then that's taxable at the end of the year. Well, because it's taxable, you want to make sure that balance is as low as possible, right? You don't want to be paying taxes on stuff that really isn't collectible. So if you know that there's a bunch of client cost advance sitting in your AR and WIP that is not collectible, get it written off. And then the balance in your asset account should be reduced as a direct result of that, and thus the taxability, the taxable amount should be reduced. Okay, so that's really, really critical. If you are not sure about this, if this is news to you, if you're confused about what I'm talking about and you want to chat with me about it, feel free to shoot me an email. I'm happy to help anyone. It is part of my standard month-end, year-end checklist to balance your client cost advance and keep that balance in jive. Make sure that it's correct. So anyone who's worked with me on these things probably knows that. But I would highly recommend looking into that if this is not something that you've ever done in the past. Okay. Unallocated payments or credit balances, unapplied payments, there's a lot of different names for them. General retainers, not trust, but general retainers. Different software products are going to call it different things. But you really want to review those at year end and make sure that, are these truly credit balances that we need to be holding? Do they need to be applied to maybe WIP and build out? Do we need to refund this money? Should we move it to trust? Just really look at anything that's a credit balance and make sure that you are really thinking through exactly what is going on with those credit balances, because again, that's something you're going to have to declare income on at year end for your tax purposes, and so you really want to make sure that that's not money that you need to declare tax on if it's not appropriate. Okay. And then, I always say you've got to balance these things. So if you've got, I don't know, $12,000 in credit balances showing in your time and billing system, you should have $12,000 sitting in the general ledger account that holds those balances. So the two should always jive. And if they don't, why don't they? So you always want to make sure that those two things are compared at your end and are matching. Okay. Again, just quickly reinforcing what I said a moment ago, review and balance your client cost advance. So the AR and WIP advances should equal what's sitting in the asset account for your client cost advance. There may be a report you can run or several reports you can run to sort of confirm that is balancing. You may want to, check this on a monthly basis as opposed to waiting until year end. Again, it's one of those things, if something's being done wrong, so much easier to figure that out in a 30-day period than it is in a whole year period. Okay. Check your year-to-date allocation. So, run some form of an allocation or a receipt allocation report in your time and billing system and make sure that all of the, what's been allocated to fees and versus costs for the year equals what your general ledger, your income statement is showing has been allocated to fees versus costs. Depending on how you break down your income accounts, there may be, maybe you break it down by timekeeper or by area of law or by office, or depends on how obviously your general ledger is broken down. So do a cross comparison and make sure that those are in jive. There could be reasons they're not in jive if there's been a whole bunch of manual adjustments from like maybe somebody unbilled and rebilled something from a prior year, that type of thing. There could be legitimate reasons they wouldn't match, but most of the time, those things are pretty much in line. So good things to check. Trust balances, again, make sure if you're needing to return money to somebody, make sure that gets done before year end. Just keep on track of those, because it's such a headache if you have to return it years and years and years later. How are you doing on your budget? You know, did you come in close? Do you need to modify things for next year? You know, how are you doing for next year planning wise? Are you going to have more staff? Do you need to adjust your payroll budgeting? Do you need to adjust your benefits? All those good things. Are you going to have to buy new fixed assets? Are you opening a new office? Are you doing anything that is going to really throw your budget out of a major deviation from this year? So just be mindful of all those items. And then obviously we want to make sure that you're tax planning, both for this year, you know, for end of year this year, but also tax planning for next year, because if there's things that you can be doing all year long next year to make your tax liability for next year better, that's really something to be thinking about. So particularly for firms that are doing really, really well, you know, there are firms that are booming. You can't just kind of come in at the end of the year and go, okay, what are we going to do to reduce our tax liability? Sometimes it's not that simple. Sometimes there's things that you need to do over a longer period of time. Things like maybe come up with a profit sharing plan or something that's going to reduce the taxable income to the firm. Be careful about certain things on your W-2s for your partners, for example, like health insurance must be W-2'd, auto allowances must be W-2'd, life insurance over $50,000 must be W-2'd. All those types of things, you really need to make sure that that's being W-2'd properly. Also, if you have partners who only ever take distributions, or it depends what kind of a legal entity you are, whether they're called distributions or dividends or whatever they're called. So you need to be really careful, because if they're ever audited, the IRS is going to scrutinize, well, did they take a reasonable salary, or did they only take distributions in the effort to avoid FICA taxes? So most of the time you have to take what's called a reasonable salary, and what a reasonable salary is depends on how much income is coming into the firm. But again, your CPA can help you with that. So you really need to make sure that the IRS, if you came under scrutiny, wouldn't say, somebody's trying to avoid FICA taxes here. That's a big problem, and something that definitely gets looked at. And they also look at partners putting personal travel and entertainment expenses and posting those to the firm. That's a big one that gets reviewed. So just something else to be mindful of. And then, of course, once you have everything for year-end done, you want to lock down your financials so that no one can accidentally post to the prior fiscal year, right? So if you lock down 2017, you sent your financial statements to your CPA, do whatever it takes in your software to lock down 2017 so that no one can make additional journal entries to 2017. Because the last thing you want is that you sent your financials and then all of a sudden more edits got made to the financials. And now when your CPA comes back, they go, wait a minute, yours don't match mine. What's going on? So I always tell people, lock it down as soon as you give it to your CPA. Now, that doesn't mean that they, when they give you adjusting journal entries, you can unlock it, put the adjusting journal entries in for things like depreciation or anything that they've found and corrected, and then relock it, okay? So you want to make sure that you're only unlocking it for the purposes of those final adjusting journal entries that the CPA has given you. Okay. Typically, one of the adjustments may be that if they're a partnership, they're going to disperse all the net income for the year, the retained earnings, out to the partner's equity accounts. Corporations are allowed to carry forward retained earnings, but partnerships are not. So that's usually one of the major adjusting journal entries at year end as well. And that really is everything. I know I'm a few minutes over, and I apologize for keeping you guys a little longer than originally anticipated. But hopefully you learned a lot, or at least something, if not a lot. And you'll be able to maybe plan a little bit better and stress out a little bit less at year end. So I'm going to turn it back over to our lovely lady, Miss Karen, who's going to give you a few little freebies that are coming up.
Great. Thank you, Britt. And I hope all of that great information helped everyone get motivated. And you're right, no need to stress if you're prepared. And now for the shameless plug portion of the webinar. We hope you'll take advantage of our year-end health check, a review in preparation for year-end. This health check is designed to get you ready for annual budgeting, CPA review, and tax preparation, as well as overall year-end planning. We're offering special discounts for all webinar attendees. Just go ahead and shoot me an email at the address there, kshear@affinityconsulting.com. We also want to make you aware of our Moneyball webinar series that's starting soon. We're making a 10% discount available to all of our webinar attendees. I'd encourage you to check that out too, and all of our upcoming webinars at affinityconsulting.com/webinars. And not to mention Affinity University, which is the next slide. It's about the webinar subscriptions. We'll make sure you get a copy of that as well. That's available at affinityuniversity.com. And thanks to all of you for attending. I will be sending out the recording of today's webinar shortly. Please join us again soon, and keep those requests coming by sharing your feedback with us on the survey that follows. Until next time, thanks everyone.
Thanks a bunch. Bye-bye.
Bye.